For years, money felt easy. Companies borrowed cheaply, governments refinanced endlessly. Losses could be rolled forward, mistakes absorbed, and balance sheets repaired with time. The world is ending. Not with a crash, not with panic, but with mathematics. Because in 2026, a very large amount of corporate debt comes due. And when it does, the cost of money changes everything. Welcome to Money and Power, where we look beneath the headlines and focus on how the financial system actually works. If you find this kind of calm, system-level analysis useful, please do like the video and subscribe. It really helps the channel, and it tells YouTube this content is worth sharing. Now, this isn't a forecast. It isn't a warning call. It's a scheduled event. Over the next year or so, well over $1 trillion of corporate debt will need to be refinanced. Much of it issued during 2020 and 2021, when interest rates were close to zero and liquidity was abundant. The debt was taken on in a very different world. Back then, central banks were flooding the system with money. Borrowing wasn't just cheap, it was actively encouraged. Today, even after recent rate cuts, that world no longer exists. And this is where the refinancing cliff begins. Because refinancing doesn't happen at yesterday's rates. It happens at today's price of money. For many companies, that price has quietly doubled or more. On the surface, that doesn't sound dramatic, but when you look at cash flow, it becomes decisive. Imagine a business that borrowed at 2% during the pandemic. Its debt matures, it goes back to the market. The new rate isn't 2% anymore. It might be 4.5%, 5% even, in some cases higher. $100 million of debt that used to cost $2 million a year now costs $5 million. That extra $3 million doesn't come from growth, doesn't come from efficiency. It comes out of payroll, out of dividends, out of investment, out of resilience. This is why the refinancing cliff matters. Not because it causes an immediate crisis, but because it slowly drains the system. For years, cheap debt kept marginal companies alive, not because they were strong, but because money was free. These are often called zombie companies, businesses that survived not through profitability, but through refinancing. 2026 is when many of those companies face daylight. Not all at once, not with dramatic headlines, but through restructurings, layoffs, asset sales, and quiet failures. And this doesn't stay confined to the corporate sector, because banks sit in the middle of this process. As refinancing risk rises, banks become cautious. They demand more collateral. They tighten standards. They pull back from marginal lending. That just doesn't affect large companies. It affects households, small businesses, mortgage availability, credit conditions across the economy. This is how a refinancing problem becomes a liquidity problem. And this is why the system's plumbing matters more than the headlines. Markets might look calm. Equity indices may hold up. But underneath, pressure starts to build. You can see it in credit spreads, the gap between safe government debt and corporate borrowing. That spread is the system's pressure gauge. When it widens, stress is building. Not panic, stress. And this is where policy re-enters the picture. Central banks don't want widespread corporate failure. Not because they care about share prices, perhaps their own, but because employment, pensions, and financial stability sit on top of corporate balance sheets. At the same time, inflation hasn't disappeared, and credibility still matters. So policymakers are pulled in opposite directions. Supporting growth and maintaining financial stability now begin to conflict. This is why 2026 matters. It's the year when the era of free money collides with the reality of market-priced money. Not in theory, in practice. And that collision doesn't produce one dramatic moment. It produces pressure. The system thins, margins shrink, weaker structures fail. Stronger ones do survive, but at a higher cost. That's the refinancing cliff. Not a wall everyone crashes into, but a ledge many struggle to climb. The takeaway here isn't fear, it's awareness. Watch credit spreads. Watch refinancing headlines. Watch which companies can roll debt easily and which cannot. Because the next phase of the global economy won't be defined by rate cuts or inflation prints. It will be defined by who can afford the new price of money and who cannot. There's one final point that's worth sitting with before we finish. When people hear about refinancing pressure, they often imagine it is as a corporate problem, something that only affects balance sheets, bondholders or markets. But the real impact shows up much further downstream. When refinancing costs rise, companies don't just cut numbers on a spreadsheet, they cut projects. They delay hiring, they reduce capital spending. That's how a change in the price of money slowly reshapes the real economy. It also changes behaviour. Companies that spent the last decade optimizing for growth suddenly have to optimize for survival. Cash becomes more important than expansion. Flexibility matters more than leverage. And that shift feeds back into markets in subtle ways. You may see equity prices hold up longer than expected. You may see headline indicators remain calm, but underneath, decision-making changes. Risk tolerance falls, liquidity becomes prized, and anything that depends on continuous refinancing starts to look fragile. This is why understanding the structure matters more than reacting to headlines. The refinancing cliff doesn't announce itself with a single event, it shows up as a pattern. A company here struggles to roll debt, a bank there tightens lending, a sector quietly slows down. And by the time it becomes obvious in the data, the adjustment is already well underway. That's also why this isn't just about predicting a crash. It's about recognizing a transition. From a world where money was abundant and forgiving, to one where money is priced, selective, and increasingly scarce. This transition, as I've said, does not happen overnight, but it does happen decisively. And 2026 is where many of those decisions stop being optional. Now, if you want to keep understanding how money, power, and the financial system really interact before the headlines catch up, please subscribe to our Money and Power channel. New videos are published regularly, and I'll see you in the next one.